Welcome to one of the most basic topic in technical analysis, and this is where we stress the importance of support and resistance. Now we know that the market is made up of the battles between the buyers and sellers, or we call it the battles between the bulls and the bears, right? So now as they are battling, they make turning points in the price charts within the wave patterns. And when it makes a turning, from downside to the upside, we might call it a support. And if it is upside to downside, we can call it a resistance. Right. So now let's go a bit further onwards. And what we want to see is that we want to see now what is the actual meaning of support. So support is the price area where there are more buyers than sellers, or we can call it more demand than supply. All right, more buyers than sellers. And as soon as the price, let's say, is coming down to that area and is more likely to get rejected by buyers, forming a support. So prices will go up from that level. All right, then how about resistance? Resistance is a price area where there are more supply than demand. So that means there are more sellers than buyers. So if a price area where you have more sellers waiting over there, and as the price goes upwards nearer to that area, the price area where you have more sellers, then it's more likely to get rejected and it turns to downwards. All right. So let's say, for instance, if we look at the price dynamics right here, if price has made a rally and going upwards, it starts to make a rejection right there. And once it makes a rejection, we call it a pullback. As soon as you see a turning point at that level, we call it a resistance. Now, so resistance is where a level where you have more sellers than buyers. So the sellers have overwhelmed the buyers, and when the buyers they have lost, so the rally actually starts to stop and it reverses from that point. So once it reverses from that point, it makes a pullback. And let's say once the pullback goes to a certain level, then it couldn't go down anymore. And that's where you start to see a rally, a turning point again. And that's where you have more buyers than sellers, right? So you have like a big group of buyers waiting right here. And as soon as the sellers keep selling downwards, then you suddenly have a lot of buyers coming here, in here, at this part. And it starts to make a rally from these price levels, right? So you have buyers overwhelming sellers. So, and then of course, the price in the markets, you have resistance and support levels are always they form a reference. Markets they have memories of previous resistance and support levels because they see it as an important level where they know when the price reaches at one of those levels, it starts to, of course, it has a probability to turn at those levels. So the market participants are very cautious. So let's say, for instance, if price is approaching to the, let's say, the resistance from this rally, all right, so then when it reaches to the resistance level, and then here you might see a group of sellers coming in again because they see it was rejected earlier and they know there's a weakness around this area of the buyers, the weakness in buyers around this area. So they come into the price, come into the markets again and they start selling from that part. So and again, price gets rejected again and starts to pull back. So again, when it starts to pull back, what happens is that the market participants will see that the levels, this support level becomes a very important level. So they will start to decelerate their selling positions, and buyers will come in and buy again because they knew that previously this price pullback starts to get rejected. And okay, and if this is a very strong stock, let's say fundamentally strong stock, and it is in an uptrend. So what is happening right here? Here we can always call it a consolidation. All right, so that means the price stalls around this area. So you have bears and bulls fighting, or sellers and buyers, they're fighting against one another for some time. But if a stock is fundamentally strong, imagine you have actually done a very a very deep fundamental analysis, and you know that this company is good to own. you have more people wanting to own this stock than to actually sell away the shares. So what happens is that whenever you have some pullbacks, it's a good opportunity to own more shares when the price goes lower. So it's like a trending upwards. The price would form a higher lows in strong fundamental stocks. So let's say for this case, it starts to break the resistance, and broken resistance can always turn into support. That means when the price once it breaks these levels, because it was seen as an important level, and the sellers has lost their battle, and the bulls they have their victory. So they know when the price that it starts to revisit these levels, it starts to turn into a support, very important level that the bulls they start to come in again. They start to buy more at these levels. So and then of course every turning point you can see resistance and support. And in a strong fundamental stock, you will likely see resistance are more likely to be broken, and resistance turns support. The support are more likely to hold. Right, so the sequence repeats again and again. Right. So now let's say for instance, if we look at an example right here, Google, and we can mark this level as a support level right here because price, although it's made a very strong rally, then of course imagine this is an athlete that has made 100-meter sprint right here, and after 100-meter sprint, the athlete has to rest for a while before it starts to make a next sprint. Then of course when it starts to rest, then you can see that price is turning around these levels. Then it starts to form some resistance, and let's say it has rested enough and it starts to make a run again, a sprint again. Then this is where the sprint, when it starts to sprint again, then it breaks the resistance and becomes a support level. And again, of course, it rests again for some time before it starts to make another rally. So every time you see the resistance that has been tested a few times, broken, the support holds for some time, and it starts to rally again. All right. Now this is one of the rally that it doesn't come back to the previous resistance, and it forms its own support right here before it starts to rally strongly. So what we can see right here is that the markets they do not move in a very linear fashion, and of course it's not 100% mechanical. Most of us will know that resistance are more likely to be broken in a strong fundamental stock. So the price doesn't move in a fashion that every time it breaks the resistance, then it comes back and tests the support once, then it flies upwards, right? Rallies. It doesn't do this. So what it does is that the price, you can see that after a rally, comes back and tests this level. It doesn't go up immediately. So it starts to stall for a while. Test. You see, this is the first test, second test, then third and fourth. So this are actually this is the weekly chart. In stock markets, I tend to use weekly charts or 2-day charts. All right. So rarely I go into like a minutes or hourly charts. So those are like noises for me. It's not very well defined. All right. So you can see every time it comes back to a certain like let's say this resistance has been broken here, and if the price comes back, it starts to test once, twice, broken resistance, test a few times, one or two times resistance, comes back, test the support, forms test this part here, then test the support again, test again, goes up, test again. So this is like 4 or 5 times right here before it starts to make a rally again. So it might take weeks sometimes. You see, these are weekly candles, broken. Okay, this one has made a strong rally, comes back here, goes up, retests the resistance, rejected, comes back to the support, gets rejected, makes a rally. So before it even makes this strong rally, it breaks up at this part, comes down here, forms a support, rallies, comes back, forms a support, comes back and tests the support, rally, comes back and tests the support. So now you can see that this support level has been tested more than 6 times. All right. So this level is because it's very likely a very key level. So this is like triple digit key level, 1000. All right, people see most of the time people see like 200 double digits or triple digits. These are like key levels or psychological levels. Price tend to actually hold or actually gets rejected strongly at these levels, dependent on the fundamentals of the stock. So the market participants sees this level as a very important level. And as you can see, the price even rallied around to 1003 levels. It starts to get rejected. So, and here when it starts to come down to this part, it starts to get rejected around 1000 level. So, all right, do take note on that. Like let's say, for instance, this one on the 700 part, this is like a key level. Now, as an investor or a trader, we don't normally buy prices that are rallying. We normally want to buy prices that to go in, to have an entry that is actually more optimum. That means that we do not want to buy when the price is doing this kind of price action upwards. Okay, we do not want to buy around this area. We want to buy when the price comes back to a certain support level. All right, so maybe the second test, this is where we want to enter before the price starts to rally again. So we do not want to buy around these levels here, as is making some rallies. All right, but of course, if you enter, if you are an investor or long-term investor, like you're holding 5 to 10 years, it doesn't really matter. But if you're an active investor, you want to actually optimize your entries and you want to average in. Every time you average in, you want to look for a support level. Like these are the levels that you want to buy in. These levels or these levels, you want to buy in at levels that starts to, before it starts to rally again. All right. So now let's go to the side where we see sellers are more likely to win. So if we know that the stock is fundamentally weak or it is weakening, then we would likely see the wave downwards is longer than the rally. So, and as soon as it gets, okay, let's say for instance, let's jog our mind a little bit again. So let's program our mind. If the wave comes down and it starts to get rejected, we call that a support level. And as soon as it starts, the rally starts to get rejected, we call that a wave down. Right. So again, of course, we have a resistance and support level. Markets have a memory that these levels are important. It starts to bounce off those levels. All right. And of course, if this stock is a very weak stock, fundamentally weak stock, then you have lower highs, and meaning that this was probably coming from a high, and the price once it starts to get rally, it gets rejected. It starts to rally, gets rejected, wave down. So and more. See, if a stock is fundamentally weak, you do not want to keep it in your portfolio because you know that it will actually hurt your portfolio and you want to unload these shares. You want to sell off the shares before it goes even lower, right? But before you sell, you want to wait for some rallies before you sell, right? So you want to sell in strength. So this one, there's some strength, and you know that of course, you anticipate the price will go lower, and before it goes lower, you can see sellers will be always the ones winning. And let's say, for instance, this part it starts to break support. For weak fundamental stock, support levels are more likely to be broken. And this sequence will likely to be continuing for a certain amount of time. Right? It keeps breaking the support, and the support keeps turning into resistance, right, as it goes further downwards. So now let's say, for instance, this is a very weak, fundamentally weak stock, limited brands. And this stock has, if you look into the past, let's say 2014 onwards, all right, this is like a very long-term chart. So this stock has made a very strong rally from the past, sharp, strong rally. Then as the fundamentals are weakening, then you start to see reversal patterns, some key reversal patterns, and this is where we call double top. Of course, I won't be covering in these topics how we trade these patterns. So these are called breakout patterns, and there are actually certain ways to trade it. Okay, let's go focus on the resistance and support level. So price gets rejected strongly here, and it didn't hold or form a support. So this is where we just draw an average line in between these candles, this price movement. And of course, this is where the price has been actually rejected from going downwards. We call it support. And what you can see here is that the price has decisively, the bears or the sellers have committed to bring the price lower. They have been selling very strongly right here, and it breaks, it forms a huge Marubozu candle, a huge red candle right here. Then it starts to revisit these levels again. So this is a very important level. So, and it is actually at the 80 key level. All right, and this is probably at this is around 100 as a key level. All right, double digits. Round numbers are key levels that most of the big hedge funds are looking at, or the smart money are looking at. So those are the levels that is more likely to be rejected, or the turning points around those levels. Right, again, and then if we look mark correctly, these are the support levels. It has actually tested twice, rejected sharply, and as price breaks lower, it comes back upwards and revisit these levels, and it starts to get rejected again. So this sequence starts repeating itself again and again and again. So now, not most of the investors or the traders, they start to spot the top right here. So it's extremely difficult, and this is where you have like pro investors or pro traders. They are the ones who will be the ones who sell at the top or buy at the bottom. All right, so these are the guys like they might have some insider infos. They are the ones who actually decide where the price move also as well. But of course, if you are a seller, if you miss this part, it doesn't matter, because a weak fundamental stock, most likely when the support is broken, it will actually become a resistance. So as a seller, you will want to sell around these levels, right here, these levels and these levels. All right. So as long as the price is let's say making a rally to the previous support level, right, breaks below, comes back, and then you might sell around these levels, the zones around these zones right here. All right. So okay, I'm pretty sure you get the concept. It's not a very hard concept right here on the selling, buying on strong fundamental stocks on support, selling weak fundamental stocks, selling on the resistance line. So it sounds simple, but sometimes I have to combine it with other factors in order to execute this more correctly or more precisely, I would say. All right, so I would like to end this session, and thank you for your time, and happy trading and investing.